Good evening. Hi. Thank you for joining us this evening. My name is Shervin Joseph. I'm with FitzGerald Financial, a division of TowneBank Mortgage. I have with me my counterpart, Sean Higgins, who's the Senior Vice President of United One Resources. We are going to hopefully give you a show, and it's a show, but it's more education than anything else. And we're going to educate you with regards to anything that and everything that you want to know about your FICO score and how to increase your credit score. And going forward, Mortgage 101, how to prepare, how to be pre-qualified for a mortgage loan, particularly in this market. So without further ado, I'm not going to give you a big preamble. I'm going to take you right to it so that way we can get to it. Now, throughout the discussion and this seminar, if you have a question, please ask the question. All right? We'll take questions as we go. And we'll also have a Q&A after as well. So Sean Higgins, again, has been in the business over 30 years. We've done business with each other for over 15 years. We've done these seminars, and we feel like we're making a dent by educating the communities at large, because there's only one way to diminish or to close the wealth gap and the home ownership gap, and that is education. So, Sean, you're up first, my friend.
Thanks, Shervin. As always, it's great to see you. Really appreciate the partnership with you and your team at FitzGerald Financial, division of TowneBank. Good evening, everyone. As Shervin has said, my name is Sean Higgins. I'm with United One Resource. I'm based in Pennsylvania. I have a presentation that we're going to put up on the screen in about a minute, and I'm going to go through some items on credit scoring. There's a lot of information that exists out there on credit scoring, but there's a lot of information that's very specific to the mortgage industry. And that's my goal, to give you an education on that and help you along your path towards home ownership. One thing I'd like to establish right up front is my contact information is on the screen. You can see it right there. I'm based in Pennsylvania. Been in this business for over 30 years now. And as Shervin has said, we've been working together for over 15. One thing I'd like to establish, everyone, is we're not a credit repair company. We are a credit reporting agency that sells to mortgage lenders. A lot of the items that I'm going to talk to you about tonight are related to the credit report as it appears in the mortgage space. I always like to start off the meeting also by letting everyone know that the best place to get the credit answers is to start with the mortgage application. The mortgage application is a great place to get a good feel for where you're at with your credit. And obviously that mortgage process also starts with the mortgage loan officer. So I'm going to go ahead and give you some information. My contact information is right on the front screen right here. So if there's any other questions after the fact, I'd be glad to answer them. So what is credit scoring? Obviously, in the in the mortgage loan process, credit scoring has a lot to do with a loan approval. And you'll see various types of credit scores that are out there in the market. There's a FICO score, there's a Vantage score. And most recently, I became aware of a lot of consumers using the Credit Karma. And Credit Karma has about 100 million users. So it's well received. However, there's a difference in that credit score. So I'm going to teach you a little bit about the mortgage score, the differences that are out there, and hopefully help you become more astute in the credit reporting process. Why is the credit reporting so important? As Shervin will say when he does his presentation, it all seems to start with the credit score. It's very important in the process. I like to promote a term that I like to use, which is called credit fitness. I'm going to teach you some awareness and hopefully guide you along the right paths to try to get a good feel for what's actually on your credit report and how it impacts your credit report. So let's talk about some score ranges. The scores in the credit scoring models exist between 350 and 800. And as you can see from my screen, you'll see the different types of, I guess you could say it's assigned indicators of what's a good credit score, what's an exceptional credit score, what's poor. So you'll see, obviously, scores below 580 are considered to be a poor credit score. Up to 670 is a fair score. Good is 670 to 739, and then you'll see exceptional 800. in my time in the business, have only ever seen a handful of credit scores at or near 850. Those people generally tend to be seasoned borrowers. They've done all the things that you need to do properly to maintain your credit score, which I'll talk about. But it takes time. Seasoning is a big part of it. And like I said, I've only seen a handful of people that have attained those types of scores. So one of the questions that we get quite a bit in our business is what actually impacts a credit score? So from the pie chart on the screen, you'll see that there's different factors, and I guess the best way to say it is a weighting of what actually has the biggest impact. So if you look at the different categories, there's payments, balances to limits, length of history, inquiries, and the types of credit. So payments is probably the biggest part of the credit score composition. Balance to limits, you'll hear me use the term utilization. They have a big impact on credit score. And the lesser ones are going to be length of history, inquiries, and the types of credit. So really, at the end of the day, it's going to be the payments and the utilization that have the biggest impact on the credit score in a positive way. We also get a lot of questions on inquiries. Do inquiries impact my credit report? Who has the right to pull my credit report? How are inquiries derived? And quite honestly, there's two types of inquiries. There's a hard inquiry, which is a type of inquiry that's made when you actually make a mortgage application or a car loan application or any type of application. That's when you're giving the credit grantor an opportunity to pull your credit report, but that's only with your approval, okay? Inquiries, such as soft inquiries, they might be done for more of an account review or someone maybe that's doing a promotional out there trying to attract clients, but a hard inquiry is the one to focus on. And remember, the thing to remember about a hard inquiry is it's usually with your authorization. It can only be with your authorization. That's a big part of that process. Do inquiries have an impact on your credit score? Truth is not really. So for instance, if you shop for a similar type of credit in a tight time frame, such as say 14 days, you may go out to visit a car lot and they may shop your credit application to a couple different lenders. As long as those happen within a 14-day time period, there's a good chance that you're not going to see much of a negative impact on your credit score. Now, if you make a mortgage application, I know from experience that 30 days after that application has been processed and the credit report has been pulled, you'll see about a 5-point decrease in your credit score. The thing that I want to leave with everyone on the inquiries is not that big of a deal, but where it can become a big deal is in the scoring models. If you have a lot of inquiries throughout the year and they define inquiries as 6 times, there's a good chance that you're headed towards bankruptcy. It's something that Fair Isaac, which is FICO's proper name, puts out, and it's really something to be leery of from a lender standpoint. So let's talk about FICO scores. Let's talk about how to improve FICO scores. Let's talk about what drives FICO scores down. Let's talk about Credit Karma, next couple of slides. So really, a lot of common sense plays into this process, improving your scores. If you're paying your bills on time, you're keeping your balances low, and you only apply for credit when you need it, chances are you're going to have a good FICO score, okay? There's a lot of things that could happen in your situation that may lead to a lower FICO score, but all is not lost. There's definitely ways to improve the credit scores. Once a credit score is not always a credit score. The thing that I'd like to also let everyone know is a credit score is almost like a snapshot. So if you're watching a race, a track and field event, and that time clicks as that runner crosses the finish line, that's how a credit score is derived. An inquiry is made, a credit report is accessed, and at that time, the actual credit score is calculated. It happens instantaneously. It's right at that time, okay? So what actually drives credit scores down? There's 5 things that really happen. Obviously, if you're recently late or have a past due a balance on your credit score, on your credit report, that's going to be negative. High balances on unsecured debt. In my personal opinion is the utilization of revolving accounts, which are credit cards in the industry term. They have the biggest impact on your credit score. So if they're managed properly, no recent lates, and the utilization is such, you're going to be in pretty good shape. If you have unpaid or recent public record information on your credit report, that's going to have a negative impact on your credit score. And to be perfectly honest with you, another negative impact would be if you have a lack of open trade. We saw a credit report not too long ago for someone that closed down their accounts 3 or 4 years ago, and their credit score was suffering from it because there was no open active trade. So it doesn't make a lot of sense sometimes to close down your credit lines, keep them open, because once again, a lack of activity is a negative on the score. 5 ways to increase your credit scores. So this is something that we talk to our loan officer clients about a lot to inform their consumers. A recent late is going to be a negative impact on your credit score. If you have an account, let's take a hypothetical situation. Say you had a store credit card and you had a recent late and it was a one-time late, okay? And it has a negative impact on your credit score. So say it drove your credit score down 40, 50 points, and it can. It could ruin a really perfect situation. Our experiences are that if you call up that credit grantor, the store card in this case, they're often, as long as it's a one-time item and you've been a good, consistent payer, they'll remove it. And when they remove it, it has a very, very positive impact on the credit score. Collections are another thing that can have a negative impact on your credit score. Collection agencies, they're salespeople too. They're trying to collect money. So if you have a collection account on your credit score, on your credit report, and it's having a negative impact on your credit score, once again, we advise loan officers to talk to their consumers, applicants, to say, I'll pay you off, but I want it removed from the credit report. A lot of times a collection account is only on a credit report as a means to collect. And when the means to collect has been obviously impacted the credit score and that debt has been paid, there's a good chance that collection agency will actually remove that. Paying your revolving balances down. If you keep those balances below 30% and obviously 20% if possible, that's going to have a maximized impact on your credit score. So once again, those balances on your revolving debt / credit cards, credit utilization, all those different types of terms, magic number is keep it below 30%, and that'll have a very, very positive impact on your credit score. Student loan payments. We see a lot of times where people have student loan debt and their credit scores are being impacted by a student loan servicer not properly reporting the student loan. Many student loans are in deferment, and sometimes there's mix-ups. And when those mix-ups happen, it has a negative impact on the credit report and consequently the score. Once again, at the beginning, I mentioned credit fitness. This would be a great item for credit fitness. Know your accounts, know your student loan servicer, know how it's being reported so that it does not have a negative impact on your credit score. Those problems are easy to correct, but prudent practices will indicate that if you're, like I said, have a little bit of credit fitness in your process, I think it'll help you out a lot. Installment loans. So you go to your local bank or whomever for a car loan, and you have a 60-month repayment term. If that repayment term is such that you're, say, in the month 50 and a 60-year term, it doesn't make a lot of sense to pay it off. Shervin will give you some instances where it makes sense to use that money for other things, because advancing payments or paying off an installment loan early does not have a positive impact on a credit score. There's better uses for that money, okay? It's one of my favorite slides. As I said before, I think about 1 in 3 or 1 in 4 people in the United States have a Credit Karma account. And what we found is there's some similarities, but there's great differences that are out there. So the FICO score 8 is the one that we use in mortgage credit, okay? Credit Karma uses a score called the Vantage score. It's like the word advantage, but without the AD, Vantage score. Same score ranges. The FICO score, obviously, it scores on all the 3 national repositories, Experian, Equifax, and TransUnion. And Credit Karma only uses 2 of the bureaus. FICO is very specific in their algorithm, how they actually calculate the score, whereas the Credit Karma / Vantage score is not. It uses terms like highly influential, moderately influential, and so on. The FICO score will not consider any rent or utility bills that are added to the file, whereas the Credit Karma will, okay? Here's the big thing to remember, though. Credit Karma will help promote credit fitness. It's going to give you great awareness of what's going on with your credit report. It's a free service. I advise people to do it all the time. I have an account. I look at it all the time to make sure everything is right. And here's the big thing to remember on this. There's a 30-point difference. So if you're looking at a score of, say, a 780 on a Credit Karma account, whether it be Equifax or TransUnion Bureau, chances are it's going to be 30 points less on the FICO score. The models are built differently, and the models they're very, very different in their calculations, but they're very, very different in their results. So there's really nothing wrong with using it. It's just be aware that when you go to apply for a mortgage is going to use the FICO 8, whereas Credit Karma uses the Vantage score. 30 points different is the thing to remember most about that. A couple other things I have towards the end of my presentation. Experian Boost is a great tool for building credit. Okay. The thing about Experian Boost is it doesn't improve the mortgage score. So that FICO 8 score that you hear me talking about, it does not consider Experian Boost accounts in its calculation. The reporting for Experian Boost is obviously Experian only, and it's self-reported information. It's going to be a self-reported utility, a self-reported cell phone, those types of things. We've even actually seen where a Netflix account with a $15 monthly balance or payment is reported on an Experian file. It can present an issue in underwriting, okay? And if it does in the mortgage process, it's a pretty easy process to opt out of it. We advise our loan officers to talk to their consumers and have the consumer log on to the Experian Boost account and opt out, and the trade lines will immediately fall off. Experian Boost is built for people that are trying to build credit for, say, getting a cell phone, younger children or people that are underserved that may have a need for credit to build credit along the way. Rental information. Okay, last year, Fannie Mae introduced a change where rental payments will be considered in the mortgage process. They always have, but the data is able to be contributed into Fannie Mae's system. However, it's considered a verification of an asset. There was some confusion in some of the publicity that was generated as a result of the rental information. It does not have an impact on the credit score. Okay, it's very important to the mortgage process, but it's not going to have an impact on the credit score. This is about a year old, and it's probably helped a lot of people with their mortgage process, but it's not going to have an impact on the credit score. One of the best things that I've seen happen in quite a while is medical collections no longer being included on consumer credit reports. So for the last many years I've been in the business, we've seen a lot of people that have unfortunately had medical collection debt reported by the collection agency to their credit report. The consumers would go ahead and pay it, but the account would stay on the consumer's credit report as a paid collection. So effective this past July, a paid medical collection has been removed from credit reports. Okay, it's a little bit of a process to get it there, but it's great for the consumer. It adds anywhere between 30 and 100 points to your credit score if you are being impacted by that. It's based on an individual case-by-case basis, but once again, think back to what I said at the beginning. Talk to your mortgage loan officer. Hopefully talk to Shervin and his team, and they'll help you understand where these kind of things can be improved. Starting this past July as well, medical collections, there's a waiting period. So when a collection agency takes on a new debt, they have to wait 1 year before they could start reporting it. The other thing that is going to happen in 2023 is any medical collection debt of under $500, and that's unpaid, will no longer be added to consumer credit reports. So that's a big deal because a lot of people have certain circumstances which created them to get to that point and have a collection agency on their credit report reporting a debt on their credit report, even paid. It was pretty unfair. I'm pretty passionate about that, but I like the fact that it's not going to be there. Last thing I want to leave you with is some websites that will help you get some information for your credit report. Each of the 3 credit reporting agencies have a website, which is listed right there, Experian, Equifax, and TransUnion, to get on their websites and learn. But most importantly, if you want to know what's on your credit report, there's a free service called annualcreditreport.com. You can look at your credit report every week. It's available You just have to get onto the website, create an account. And what is very, very important to know is there's going to be some challenge questions along the way that may ask you where you lived in this year or who you had a car loan with in that year, that type of stuff. It's a great service. It's free. They may try to sell you a score, which you don't need. Credit scores, once again, if you want to look at Credit Karma, just be aware that it's about 30 points higher than what you have. And then the other thing is start with a mortgage loan officer. That's the greatest place in your pursuit of a mortgage and home ownership. The last bullet point is just opt-out pre-screen. That's a website that consumers can go and have their name taken off the national list to stop receiving pre-approved offers of credit and insurance. I'm pretty passionate about this as well because this is something that a lot of times when someone gets a mailer at home and their mail has been compromised, and when that happens, it's very, very difficult for the bad guys to get a hold of your information if you've opted out. So that will stop those unwanted solicitations of coming to your home. That's pretty much it, Shervin. As always, I appreciate the opportunity you present and the opportunity to present. We'll be looking forward to any questions anybody has along the way, and rest assured, you're going to be very, very impressed with Shervin's presentation.
Well, thank you, Sean. As usual, it's a magnificent job. Nobody does credit better than you do. And the great thing is it's all accurate information, folks. And that's critical, is that you get an accurate information. Sean had mentioned he is not credit repair. Okay, it's a big deal because I'm not a big fan. The credit repair has its place, I'm sure. But the money that you use from these entities that say they're going to repair your credit and it costs you $500, $1,000, $1,500, you could use that same money to pay off or pay down bad debt that is costing your score to be low, thus increasing your credit score, or even using that money towards closing costs to purchase a home. So I think that sometimes folks use that money in a frivolous way, and people are just gaining the system and taking advantage of a situation that folks might be in a bad situation trying to get themselves better. One thing I know about Sean, he's as passionate about credit as I am about mortgages. So I love the fact that he gives you accurate information. So with that said, I'm going to start my presentation. And I've been in the business about 36 years, former Marine, and I've held just about every position, branch manager, division manager. I am right now a mortgage loan officer. I am also a diversity outreach manager. So in that vein, you should know that I am extremely passionate about literacy and ensuring that we decrease and close this home ownership gap. Home ownership gap, just listen to these numbers real quick. According to the U.S. Census Bureau, 75% are homeowners that are white, as opposed to 44% that are Black Americans. White Americans, 75%, Black Americans, 44%. We have to do a good job. And the best way to do that job is what Sean just did by educating you about credit. And what I'm about to do is to educate you with regards to mortgages. So, TowneBank Mortgage. FitzGerald Financial is a division of TowneBank Mortgage. Forbes magazine back in January, February of this year, out of 5,000 banks in this country, named us number 9 in the country, number 9 performing bank in the country, which says a lot about our credibility and the way we do things. We're very proud of being named number 9 out of about 5,000 banks in the country. So why do you choose us? Well, we're going to get you loans tailored to your specific needs. We're going to personalize the service. You're going to have someone like me working with you on a constant basis throughout the process. We are very aggressive as far as competitive rates are concerned. Now, of course, we're in a climate where rates are going up, but we are still very aggressive in that climate. Close time, when we close a loan from the process and inception to closing, usually a 3-week close. It's not 30 days, it's not 45 days, it's usually 3 weeks. Matter of fact, I know for a fact that competitors have changed the way that they've done their process just to compete with us on closing loans from a speed standpoint because we're so quick. So if you're thinking of buying a home, and what are your options? Well, you could rent and have no control over your rent increases. There's no tax deductions for rent. There's no privacy when you rent. You're limited to the ability to personalize your space. But when you own, you build equity. You claim a tax deduction. You have 0 down payment options available to you, which I will discuss as we go through the seminar. We customize your homes, your home, so that way it's your home. Fixed payments options. You know what? There are people that's going to talk to you about different types of options. I'm going to speak to you about fixed payment options. We're not that far in the woods where you still can't get a great fixed payment option compared to the climate that we're currently in. So you have to ask yourself if you're ready to buy a home. Do you have a steady income? Do you pay your bills, including your rent, on time? Do you have low to medium debt? Do you any money in your savings? Do you save your money? Do you have the ability to make mortgage payments? And, do you have okay to good credit? These are all questions that you should be asking yourself beforehand. And so then comes the importance of the pre-approval. And you'll hear people toss around pre-approval. You need to get pre-approved. You shouldn't be out shopping for a home or even going into homes and looking without knowing what you're pre-approved or pre-qualified for. Before you shop, you have to know what what's in your wallet, right? So it doesn't make sense going to look at a home that's 500,000 or 600,000, but you might only be able to qualify for 300, 350. You need to know that in advance. So it's realistic pursuit of properties. It strengthens your buying power. You understand the difference between what you qualify for and what you really can afford, because there are other debts that you have that might not show up on your credit report. And it's important that you don't buy a house to live for the house. You buy a house so you enjoy the house, and you could also enjoy life while enjoying your house. Understand that loan programs and how to use them to leverage your purchase. Review your credit for accuracy beforehand. You just got a clinic on credit from Sean. So you want to obtain a yes or a when you'll be able to do an application as opposed to a no. So the difference between what you qualify for and what you could really qualify for is important. So the qualifying factors presents you with the 4 C's: capacity, credit, capital, and collateral. Income, capacity to repay the debt based on your earnings and employment history, expenses, number of dependents, and other obligations you have. Credit, history of how much you owe, how often you borrow, if you pay your bills on time, if you're living within your means. Assets, capital, or the amount of cash you have for a down payment and settlement costs, as well as cash reserves to deal with repair or replacement expenses that may arise after you're in the home. Property, collateral to protect the lender's investment if you can't repay your loan. The home you buy must be worth what you pay for it. So what factors affect your monthly payment? Well, they're the rates. And we all know that right now rates are on the rise. But, don't be one of these people, I'm going to outweight the rates. Well, you'll wind up outweighting the rates and you might outweight your ability to purchase it all. So why not get in position right now so you could purchase and take advantage of the equity that you could buy your next house, or that you could take advantage of owning a home. And if you need to refinance down the road, you refinance. But it is always a good situation to own rather than rent. So you ask the lender for their current mortgage and interest rates. Interest rates change daily and can change throughout the day depending on the market volatility. And I'm here to tell you the market is a little volatile right now. Ask the lender when you can lock in a rate to avoid increases to your payment. Typically, this can be done at the time you have a ratified contract, and that's absolutely right. Once you have a ratified contract, that's when the ball really starts going. Up until then, you're in the pre-approval process. But once you have a ratified contract, all systems are go. We can get you locked in and get everything squared away. Make sure your lock on your interest rate is locked in until the day you close, or even a little after. Origination points or discount points of fees paid to the lender for the loan or can be linked to the interest rate. Usually the points you pay, the lower the rate. Ask for the examples of payments with points and without. This will give you a better idea of paying points. I will tell you this. I am a big 0-point loan lender. I don't like putting people in position where they have to pay points just to get a rate. It's not in your best interest. It cuts into your closing costs. It cuts into your down payment. It cuts into your reserves that you might have for buying furniture after you have your home and so forth. So it's critical that you pay attention to all of that. There's the notion that you have to put 20% down is ridiculous. And the unfortunate thing is people still believe that because they get wrong information. When some lenders require 20% for the purchase price as a down payment to avoid mortgage insurance, that's a fact. However, there are loans, government loans such as FHA and rural development, which is a USDA loan, that FHA is 3.5% down. Rural development, which is USDA loan, and I'll talk about these shortly, is 100% loan. Most lenders have options to buy out mortgage insurance, and we'll discuss that as we get into it a little further. So what's included in your mortgage payment? So your principal and interest is your base mortgage payment. That's what makes up your mortgage. Your taxes and insurance, your property taxes and insurance is also included, and it makes up your PITI, your principal, interest, taxes, and insurance. That's what your total payment is all about. So when you come to mortgages, what mortgage is right for you? Well, there's a conventional. Conventional, you could put down as little as 3% down. FHA is 3.5% down. Then there's the renovation loan and so forth. And I think that if you're looking at a renovation loan, yes, you could do that, but you need to make sure that you really understand that process. That could be very cumbersome to a first-time home buyer. USDA is perfect for rural buyers, or even if you're just outside the suburbs or in the suburbs, because it's not a particular area. Please understand when I tell you this. USDA is not to say if you're around the Beltway, you're in Waldorf or you're in Brandywine. USDA is just outside of a certain area. It's a national product, but you have to put the address of the property in the system to see if it's USDA approved. If it is approved, that's 100% financing, and that's a great product. Okay, there's only one other 100% financing, and that's a VA loan. I understand we have questions. Sean, do you see any questions?
Shervin, there's two questions from David.
Okay.
First question is, what does a ratified contract mean? And there's a follow-up question as well. What's the minimum credit score you need to be eligible for a home mortgage?
The first question, ratified contract is a contract when you, as the buyer and the seller, agree that the seller is selling you the home. You've both gone through the negotiation process. You've ratified it. You've put your signatures on it. And that means that that you have a contract to purchase the home. Once that contract is ratified by the seller and by you, then you're ready to go. And that's when the process really begins. Now, the second question.
What is the minimum credit score you need?
The minimum credit score that we require is a 620 score. And if you're at a 590, 580, we'll look at your situation and see how we could help you increase it. That's where Sean comes in. And Sean, his company, again, everything is done with transparency, but if you follow their simulator that we all have as loan officers, we will calculate in the system what will it take to get this person from a 580 to a 620, and it will tell us, hey, they need to pay down this bill, pay down this bill. It could be 2 revolving accounts. It could be a removal of a collection. It could be a number of items that are really small in nature that you don't have to go to a credit repair person to pay thousands of dollars. You could just get that done through us and through Sean. And it could be anywhere from 1 day on a rush or 3 days in normal time to accomplish getting your score where it needs to be. So to answer your question, our requirement is a minimum of 620 FICO score. Hopefully that answers your question. And if you have any other questions out there, please feel free to ask it, because we're going to take questions as we proceed. The 100% financing is, as I said previously, is the only other 100% loan other than USDA. So when people tell you that they have 100% loan for you, they don't. Those are the only two. The 100% they could talk to you about is maybe a grant of some sort to make it 100. But keep in mind, those two are not, those are the only two true 100% loans. So conventional loan we just discussed is 3% down, competitive rates. It's a 30 or 15-year term. You could go as low as 3% down. Usually it's 5% down, because 3% down will require pretty decent credit. If you want to eliminate mortgage insurance, which protects the lender against anything happening to the property, you would require to put down 20%. They're fixed rate products and ARM options. And it said there's ARM options, but I tend to stay focused on fixed rates. I don't like people, particularly first-time home buyers, getting into an ARM product. FHA loan, the down payment is 3.5%. You could actually use a gift from your mother, father, sister, brother for the down payment and for closing costs. But keep in mind, an FHA is a government loan, and it has more flexibility than a conventional loan. Also keep in mind that in the industry, most government loans, FHA and VA loan, their rates are going to be about 0.75 of a point to 1% lower than a conventional. So FHA gives you a lot more latitude than a conventional loan would. Now, we said earlier that there's rehab loans and renovation loans. That goes with the FHA loans, and that's available in with that type of loan. I understand that we have another question. How do you determine the best mortgage option, FHA or conventional? That depends on the person, the customer or consumer, and it depends on whether or not what their score is, what kind of assets they have, to close on the loan and so forth. So all of that plays into the equation. But if you're a first-time home buyer, you have X amount of dollars to get in, we have to review that situation and see what's best for you. Usually an FHA loan is a good instrument to use to get into your home. VA loan speaks for itself. So VA is uniquely is a unique loan, and it allows the active duty reservists or veteran borrowers the opportunity to purchase with no money down. I mean, it's just the best loan. If you're a veteran and you haven't used your entitlement, you need to call me, call a lender, and find out if you're qualified and use your entitlement to purchase a home. Keep in mind that no money down, and it's a loan that will allow the seller to pay just about all your closing costs. So I've seen a lot of veterans go to closing with no money coming out of pocket. I'm just saying, you served your country. I'm a former Marine. You served your country, used the entitlements that you've earned. USDA, we were talking about the other true 100% loan before, is a guaranteed rural housing. It helps borrowers achieve the American dream with zero down. It's 101% financing because it has a guarantee. The VA loan has the VA funding fee that helps guarantee the loan. The USDA loan has a guarantee that helps guarantee the USDA loan. It's ideal for borrowers with little to no cash. It's no money down. And again, it has to be a USDA approved home. Very flexible on the debt ratio, and that's qualifying and so forth. But again, that's something that we will discuss when you come in for the pre-approval process. Now, grant funds. I'm going to skim through these because grant funds, we're going to get into that. And what I might not have mentioned, that we're going to be doing a series next week we're on, and the next 3 weeks. And the next 3 weeks, we're going to be talking about grant funds. We're going to get more in depth into USDA and VA and so forth. So we're here to educate you. We have a question. How do you get a loan with a score under 600? Well, you don't get a loan with a score under 600 because if your score is under 600, we will see what we could do to help you increase your score so it's in excess of 620. And you'll be surprised at how many people get their scores not only increased, but it's not just going to 620. It's going to 640, 660. It depends on their circumstance. It depends on if they follow what the simulator told us and what the credit bureau tells us, which is Sean's organization tells us in the system. Hey, if you pay this and this, your score will go to this, and it usually does. It's science. It's factual. So yes, we will help you with your score, at least see what we could do to get you to increase your score. So there are different types of grant funds. The Maryland Mortgage Grant Assist, and these funds are available to you. Smart Buy, DC Open Doors, the FHLB grant, that's the First Home Loan Bank grant option, Virginia Housing, which has a number of opportunities. And again, in the coming weeks, we will get into detail with those types of grant programs and how credit affects you with those grant programs, because grant programs, believe it or not, even though the state is giving you a grant, there are strict requirements that has to be adhered to so that you could qualify for it. But keep in mind, just is just a nugget for the coming weeks. You could get up to 3%, 4%, 5% grant program to help you with your down payment or closing costs. And then it will leave you needing just a limited amount of funds to get into a home. So food for thought. We've got some great information coming to you in the next 2 to 3 weeks. Now, student loans. Student loans, as we know, everybody just takes a deep sigh when they hear student loans, because a lot of our borrowers have student loans that it's been a problem, a thorn in their side. Now, up to about 2 to 3 years ago, it was a thorn in everyone's side. And we used to have to use, was just whatever was 1% of the loan balance of your student loan. Now, a lot of people think just because your payment is deferred on your credit report or on with your student loan entity means that you don't have a payment due. That is incorrect. We have to either put now, 3 years later, 0.5% in your qualifying, which allows you the ability to qualify for more. Now, with all of that said, for student loans that have a payment reported on your credit report that is greater than 0, you may use that payment in qualifying. It used to be that you couldn't use that. Now, if it's on your credit report, it's greater than 0, we could use it. All you have to do is provide a documentation. For student loans that have a payment reporting on your credit report for 0, you may use the payment equal to 0.5 of the loan balance, which I just mentioned to you. If a payment amount used to qualify is less than the monthly amount reported on the borrower's credit report, the lender must obtain documentation, which is what I said to you a few minutes ago. It is so much better for you if you have documentation that reflects the payment is a lot less, or if it's deferred, then you have documentation showing it's not deferred. This is the minimum payment that you have an agreement with the student loan entity to pay. It's really put a lot of students, or former students rather, in a really good situation to qualify for a mortgage. Now, VA amount listed on the credit report, and we go through exactly the different types that allow you access. So, with conventional loans, it's for the student loans that have a payment reported on the credit report that is greater than 0, we will use that payment and qualify it, or 0.50. USDA is the same thing. So yes, we're in a better situation. I understand we have a question. How does the current rates impact the ability to buy a home? Well, the current rates, obviously, stating the obvious when I say the rates increase, so the payments are going to be higher. However, it's not that general an answer. The answer is it's predicated on what the individual borrower and how it applies to that person and their qualifications, their income, their debt situation, their credit score. So what you might find for someone else, the other person might be more qualified because they have more income, and the person that wasn't as qualified might have to buy a little less house. But as long as you have the ability to buy a house, that's it in a nutshell. And if you can't tell I'm passionate about educating and literacy, trust me, if there's a way legally to get you in a home, I will be there for you, because I believe that everyone should have the opportunity to purchase a home. Your score is very important, your credit score. And I am not going to touch the credit score because we just had an expert with Sean Higgins give us the best that you could get with credit information. But when you come to me, We will discuss your situation and we'll show you exactly what needs to be done. So one of my favorite parts, and I know a lot of people that I've done this for love these, because this comes to conclusion when I give you the home buying don'ts. So this is what happens to you before you start and while you start the process. These are don'ts. Please pay attention. Number one, do not change jobs, become self-employed, or quit your job. Okay? I think that people read the do not change jobs. If you're making more money, by all means, you will be fine. Okay? But if you're going to be self-employed, you can't do that because you need 2 years to be self-employed, 2 years tax returns to prove a paper trail and track record of the income that you make. So if you don't have those 2 years and you just became self-employed 4 months ago, you're not going to be able to purchase a home until you're able to provide the lender with 2 years tax returns. Don't quit your job, because then you can't purchase a home. You can't afford it. Number two, do not buy a car, truck, or van, or you may be living in it. While it sounds funny, it's very much a reality. You wait till you own the house, wait till you have your keys, then you could go see if you qualify for a car or truck and put that nice car in your garage or in your driveway. But until you have a house, don't do it. Number three, do not use charge cards excessively or let your accounts fall behind. Just because we ran a credit report does not mean that we're not going to continuously look at your situation up until closing. I'll give you a little tidbit here. Right before closing, most lenders do a soft pull to make sure there's no additional debt on your credit report or that we missed that wasn't on the application. It's very important that we qualify you from the beginning and qualify you at the end. We don't want you to default on the loan for debts that we didn't count. So it's critical that you don't open up any debts while you're processing the loan. Number four, do not spend money you have set aside for closing. No Cancun trips, no going down to Miami Beach and having a good time and then you come back. You know, this is your life. This is your investment. You've been waiting for some time to own a home. Finish it. Finish the dream. Get in your home and focus on that. Number four, which I just read to you, has happened numerous times. Number five, do not omit debts or liabilities from your loan application. You're signing an application telling us everything you told us is factual, and we will hold you to that. Number six, do not buy furniture. You don't own the home yet. Wait until you have the house. Then you fill your house with all your beautiful furniture. Number seven, do not originate any inquiries on the credit cards, because usually that leads us to believe that you have to explain everything. If there are other credit cards, it might be debts. So just try not to do anything in that window. Again, we'll close you in 3 weeks, but anything comes up could prolong that issue or the process. Number eight, do not make large deposits without first checking with your loan officer. Okay? Do not move money around. Keep everything simple. Talk to your loan officer. Usually, if we talk and we have a conversation, we could figure out what you've done and make sure that everything, as long as you could provide a paper trail. Number eight, do not make a large deposit with what? Well, I just said that. Number nine, do not change bank accounts or move money between accounts. I also said that. And number 10, do not co-sign a loan for anyone, usually before or while you're in the process. I know relatives, friends, you have the great credit, they feel they could depend on you. Don't put yourself in a situation when this is the one time you want to be a little selfish because you're purchasing a home. Take care of your business, take care of your family, get your house, live the dream, And then if you want to co-sign for someone and you think that's important, that's up to you. But don't do anything to jeopardize your ability to purchase a home. And if you have any questions whatsoever, please ask. I'll be more than happy to answer any questions, any additional questions. And here's my contact information. I could be reached, my phone number, my email address, 571-278-8351. And my email address is on there as well. Do we have any additional questions? Well, I don't think so, but you could always call me on a sidebar or privately. I'll be more than happy to take care of you, and we'll go from there. Well, it's been great. As usual, Sean, we've come to the conclusion of another event.
Yes, sir.
And I thank you for your participation as always, and look forward to next week when we're back on with round 2 in our series of home ownership. So Sean is going to be here next week and for the next 3 weeks, along with me, answering questions with regards to credit and just giving you pointers on any instruments that might be able to use to get to that American dream. So we thank you for your time and we appreciate your attendance. Take care.
Thank you. Great job, Shervin. Thank you.
Thank you. And the same to you, sir.